Rising insights about subprime lending across auto, personal loans, and non-QM mortgages. There's a lot of misunderstanding out there. People often assume subprime simply means high risk, high interest, and bad outcomes. But the last 5 years of data tell a very different story. Let's walk through the most counterintuitive findings. First, subprime lending often behaves in a counter-cyclical way. When the economy weakens, demand from subprime borrowers actually rises, especially in auto. People still need transportation to work, even when times get tough. And when prime lenders pull back, subprime lenders who stay active gain, share, and enjoy wider spreads. Another misunderstood point is that bad credit does not automatically mean bad payer. Many borrowers with low credit scores pay extremely reliably because their car is essential to their job and daily life. Credit scores simply can't capture context, like medical events, temporary job loss, or thin credit files. This is why a portion of deep subprime borrowers consistently outperform some mid-600 score borrowers. Here's another one most people miss. Loan defaults don't usually peak during a downturn. They peak after a recovery begins. Borrowers use savings, credit cards, tax refunds, and informal income sources to push through the hardest months. When life finally stabilizes, unsecured loans are often the first bill they stop paying. This creates a 6 to 12-month delay in delinquency waves. Now let's talk about expanding the credit box. It sounds risky, but done correctly, it can actually reduce overall losses. That's because behavioral patterns, like job stability, phone number consistency, or residential history, can be more predictive than credit scores alone. Adding low score but stable borrowers diversifies risk and smooths out portfolio performance. Another surprising insight: higher APR does not always mean higher profit. After a certain threshold, raising APR increases early-stage defaults. More defaults lead to more charge-offs and more repossessions. And repossessions destroy value quickly. So profit actually peaks before the APR ceiling, then drops sharply. Repossession itself is a misunderstood topic. Some think lenders make money on repos, but the opposite is true. By the time you add towing, storage, reconditioning, and auction fees, most repos result in a loss. Successful lenders focus on preventing repos, not relying on them. Another insight: geography often predicts loan performance better than credit score. A 580 borrower in Texas behaves differently from a 580 borrower in California. Differences in insurance costs, wage patterns, living expenses, and state-level repo laws have a big influence on risk. Regional inflation alone can shift early-stage delinquency by 20 to 40%. Finally, let's talk about what truly predicts repayment. Life stability, not credit score, is one of the strongest indicators of performance. Borrowers with stable addresses, stable employers, and stable phone numbers often outperform their credit score expectations. Credit score describes the past. Stability predicts the future. These insights show that subprime lending is much more complex than stereotypes suggest. It isn't simply about high rates or high defaults. It's about behavioral economics, regional factors, and how people prioritize essential payments. Understanding these counterintuitive patterns helps explain why subprime lending continues to be a major part of the U.S. credit ecosystem.